Imagine you usually keep your money in a fixed deposit at a bank that pays low interest. Now, another bank nearby offers higher interest rates and seems safe. You would likely move your money to that bank to earn more. But what if that second bank suddenly faces problems, like new rules or risks that make it less safe? Then, even if the first bank lowers its interest rates, people might still prefer to keep their money there or look for a safer option. This is what happened a few months ago between the United States and Europe. Before we go deeper, if you've ever felt confused by headlines about the economy, currencies, or interest rates, this channel is for you. I make these videos to simplify money talk, not for experts, but for everyday people like you and me. If even one part of this helps you understand global money better, please hit like and subscribe. Your support helps keep this free and easy to understand, without jargon or noise. Now back to the story. The European Central Bank cut interest rates to help Europe's economy grow. Normally, this would make the euro weaker because lower rates mean lower returns for investors. But instead, the euro became stronger against the US dollar by more than 10% in just a few months. Why did this happen? First, the United States government introduced high tariffs on European goods, like a 25% tariff on cars and 20% on other products. This made investors worry about the US economy and trade policies. Because of this uncertainty, many investors moved their money from the United States to Europe, looking for better stability and opportunities. Second, Germany, Europe's biggest economy, increased government spending. This gave investors confidence that Europe's economy would improve, attracting more investment in euros. Now, what does this mean for people in India? When the euro becomes stronger, buying European products gets more expensive in Indian rupees. Imported goods like European chocolates, perfumes, or machinery will cost more. Traveling or studying in Europe also becomes more costly. On the other hand, Indian companies that sell goods to Europe can benefit. A stronger euro means that Indian products become cheaper for European buyers, as they now need fewer euros to buy the same amount of goods priced in rupees. This makes Indian goods more attractive and can increase demand in Europe. However, when Indian exporters convert the euros they earn back into rupees, the final benefit depends on the exchange rate between the euro and the rupee. For Europe, a strong euro makes their exports more expensive for other countries. This can reduce demand and slow economic growth. A strong euro also makes imports cheaper, which can lower inflation. But the European Central Bank wants inflation to stay around 2%, so a strong euro creates challenges for their goods. In short, the European Central Bank has a tough job. They want to grow the economy, but the strong euro works against them. These global money movements affect the prices we pay and the economy in India too. Understanding how money moves between countries helps us understand why things become cheaper or costlier. If you found this video helpful, please like, share, and comment. It helps this channel grow and reach more people like you. This is Demystify Finance, helping you understand the world of money in simple words.